IPDA Insights here, and there's our first piece of our free content. And on this episode, we'll be focusing on the introduction to advanced market structure. And you might as well wonder why we are starting off with something that is pretty much advanced. And the truth of the matter is, if everyone here or most of you here who found yourself on this episode have been through the retail world, then you'd actually been part of the puzzle that dictated that whenever you be having the market making higher highs and breaking and making higher lows and breaking highs and all that, that's how we determine that we are bullish. And then whenever the market is doing the opposite, we are probably bearish, right? And that actually made sense whenever wherever or whenever you learned that, but whenever you tried putting that into the chart, you had some form of inconsistency. Why did that happen? It happened because retail logic doesn't work. Everything that you've read in books, it doesn't work. It doesn't work. It's meant to sway you away from the true nature of the market. So today, try taking notes. It's gonna be very important. You're gonna abandon that retail logic at the end of this class and moving forward, because truth be told, there's no way of being profitable in the market and having a vivid view of the market using retail logic. So, what do we have as IPDA Insight? We have brought upon a way of viewing the market in a science perspective. What do I mean by that? If you're viewing something from a science based perspective, then you need to be having some form of consistency, some predefined context, and predefined ways of looking at the market. So, what do we have diving into our advanced market structure? Well, we have the perspective. For starters, we have the long term perspective, which is a focus on the daily or the 4 hour time frame. And then we have the intermediate term perspective, which is solely based on the 1 hour time frame. And then we have the short term perspective, which is based on the 15-minute time frame and lower time frames. We'll get to collaborate that with our teachings as we move forward. And then we have our abbreviations. And for this particular class, we'll be using logs. If you just want to understand the opposite of it, you flip it over for highs. So what do we have on our abbreviations or terminology? We have our long-term high, no, rather long-term low, which is our LTL. And then we have our ITL, which is our intermediate term low. We have the STL, which is our short-term low. We have the MSB, which is our market structure break, and then the MSS, which is our market structure shift, which is usually confused with market structure break, but you know, it does happen. It does happen for retail traders or somebody who claims to know how the smart money views the market. Anyway, you get to that understanding as time goes on, and we'll get to define all these abbreviations and how you'd actually identify them on the chart, where to look for them, and how to put them into practice, how to benefit from this market structure, collaborating it with other content that is in the strategy. There's a lot of content in the strategy, and we're just putting this out because it is our prerequisite, a prerequisite to our strategy. You need to be learning this before you can actually have a chance at grasping whatever the strategy entails, which is very, very interesting. Very, very interesting. Far much interesting than anything you've probably seen or been through. So let's start off with our long term law. What does a long term law entail? A long term law, as you can tell, is from a long term perspective. So it is a swing law that is framed on a daily or 4 hour level of support. I'll make a sketch to actually help you understand what I mean by that. And what is the essence of this swing law? The essence of our swing law is it should not be broken by any retracement until, keynote, until we trade to our target. There's a certain way of understanding target after entries and all that. So we'll get that in We'll get into that part in the strategy. And then we have our intermediate term law. It basically entails a swing law that is formed whenever the market retraces to rebalance any form of an imbalance in that swing rally that was made from the long-term law. You'll understand with the sketch. It will help you understand. And then we have our short-term law. Our short-term law, these are the laws that are found in between our intermediate term laws and long-term laws. So we'll actually get into that. And each aspect's essence as we proceed. Now proceeding to our sketch to help us understand our key levels. So we have our daily time frame level of support right here marked in this black horizontal line, and then we have our key levels marked out in the abbreviations that I was explaining a few moments ago. Well, we have our long-term law right here. It is framed on the reaction that it gave on this key level of support, right? So this long-term law, as mentioned before, should not be broken by any further retracements. And let's assume we have a target right here. Just gonna mark it in red so we understand, or in blue. Out here, use blue. That's our target. Up until the market reaches this target, up until the market trades through this target, then this long-term law, as long as it's valid, should not be broken. And then we have our short-term law, and then we have another short-term law, and here we have an intermediate term law. And we said an intermediate term law rebalances any form of imbalance that is found on this price rally that was made from this long-term law to that high. So this intermediate term law comes to rebalance any imbalance that is found here. And how do you validate a long-term law? An intermediate term law rather. An intermediate term law has two short-term laws on each side of it. We have a short-term law on the left, we have a short-term law on the right. That's our intermediate term law, which is the lower law between those two laws. And this is known as the classical intermediate term law, because we have the classical and the rebalanced, and you actually get into that narrative if we see the rebalanced version of an intermediate term law on the chart. And both of them actually entail two different things. You'll actually realize that the market is always giving us a hint on what it is bound to do next using this particular market structure and looking at this key levels. And then what do we see again? Whenever the market comes back to rebalance an imbalance found on the rally made by the intermediate term laws, then it forms another intermediate term law. Simple as what we was doing for the long-term law. Whenever the market comes back to rebalance an imbalance found on the rally from the long-term law, then we form what? An intermediate term law. So whenever the market comes back to rebalance any imbalance found on this rally, then we form what? Another long-term intermediate term law. And whenever the market keeps on doing the same thing up until our target is reached, we'll be forming what? Intermediate term laws. And then all the inner laws that are found within this structures, we'll be having what? We'll be having what we call short-term laws. So how would we proceed with this on the chart? So I'm going to use this chart, this ES S&P 500 for our example, and I'm just gonna pick any random trade that had transpired. Well, for this example, I can see an order block right here, and the market traded off that order block. So we're gonna use that trade to actually explain how the market bought from that level using what? Advanced market structure and other concepts that are elaborated in the strategy. Well, I'll mark off the key levels for this order block, and then the key targets, everything will be marked out perfectly, perfectly with ease. And this stuff is very much easy. Once you're into the strategy, you'd know what to look for and where to look for targets and all that. So in this case, our black lines will be our targets, will be our targets. And you can see how the market traded to those targets. Well, this is not to show you that the market did indeed trade to those targets. We just want to show you how we would go about when the trade is still right here. So let's mark out this shaded area. Let's shade out this area because it's going to be our point of interest moving forward. That's where we should be focusing. Okay, so we've established our level of support, which is this order block, level of support. So what are we entailing? We're entailing that our long-term low will be formed where? It will be formed on this law, because it is the only swing law that is what? That is retesting that high time frame level of support. So we can go to the 1 hour time frame to find what? The intermediate term laws. Let's just reset this. So there's our 1 hour perspective. We have already established this long-term low from our daily time frame, and there's our key level of support, which is our daily order block. So for our intermediate term low, it says it needs to rebalance any imbalance that is found on this price rally from the long-term low to that high. So what do we have? We have an imbalance right here. We have an imbalance right here. We have that imbalance right here. So which law rebalance that imbalance? It's right here. We have our intermediate term law right there. Let me just mark it out. Intermediate term law. What's the essence of an intermediate term law? It should not be broken by any further retracements. The same way a long-term law should not be broken by any further retracements up until we trade to what? Up until we trade to our target. Where's our target? Our target is marked out in black. There it is. So up until the market reaches that level, all these two levels should not be broken. And what do we have for an intermediate term law? We have two short-term laws. We have this first short-term law on the left side of it, short-term law, and then we have another short-term law on the right side of our intermediate term law. So once we have this, how can we proceed from this narrative and keep on using our key levels, market structure key levels, advanced market structure key levels? So we said whenever the market comes back to rebalance any imbalance found on this price rally, any imbalance found on this price rally, then it forms what? An intermediate term law. So we are expecting that this would be our intermediate term law. What is it rebalancing? There has to be an imbalance somewhere. And if you look right here, we have another imbalance right there. We have another imbalance right there. You might think it's too small, but there's the 1 hour perspective, and it's a very high time frame to identify imbalance as well. So we have that imbalance right there, and we can see how that law actually rebalances that imbalance. So we have another intermediate term law right there. Intermediate term law right there. And what's the essence of this intermediate term law? It should not be broken up until we reach what? We reach our target. So why would we use this law instead of that law? Well, those are the questions that you'd find the answers in the strategy. Because if I can just give you a clue, we have a pool of liquidity right here in the form of equal highs. Anyway, let's proceed. Let's see if indeed the market trades to our target without breaking any of this key levels. We have to see the market respecting this law, respecting this intermediate term law, and respecting that intermediate term law. If it breaks it, then it basically means that our bias and our analysis is flawed or it's wrong. That's why we use advanced market structure, because it's a science. With a science, if something doesn't follow a certain rule, we don't need to be giving exceptions to it. We need to be straightforward and calling it out as a foul. So we can see how the market trades all the way up there, trades all the way to our target, and then eventually fills into that last target, which is the last top level black line. And we can see how the market never broke any intermediate term low. This long term low was never broken. This intermediate term law never broken. This intermediate term law never broken. And further, no other intermediate term laws were broken. Because if you look at this law, it's not rebalancing any imbalance right here. So we cannot actually point it out as what? As an intermediate term law. And this law is not rebalancing any imbalance right here, because this price rally has no imbalance on the 1 hour time frame. So with that being said, buckle up for our next class. We'll dive into the opportunities and possible entries and the confirmations that you'd get using this particular approach to market structure.